Do you ever feel overwhelmed staying ahead of your credit card balances? Well, if so, you are not alone.
Are you shrugging off this little maelstrom in regional banks, or is it a sign of things that you're continuing to track?
And there are some dangers there, though, as well. I mean, I wish there were more credit literacy classes.
Every month, millions of people make one financial mistake, and banks absolutely love it. Breaking down the biggest financial stories shaping America today. This is Fiscal Forge. For most people, the ideal bank customer seems obvious. Someone responsible. Someone who pays on time. Someone who uses their credit card carefully. Someone who never misses a payment. And in many ways, that's true. But here's the part most people never hear. The most profitable customer isn't the person who pays their balance in full every month. It's the person who doesn't. The person who keeps a balance month after month, year after year, making payments, paying interest, and staying just comfortable enough to continue borrowing, because modern credit card companies don't simply make money from transactions, they make money from time. The longer debt remains unpaid, the more valuable that customer becomes. And that's exactly why credit card debt has become one of the most profitable financial products ever created. Today, revolving credit card balances in the United States measure in the hundreds of billions of dollars, according to data tracked by the Federal Reserve and Consumer Finance Reports. That's not just debt. It's one of the largest profit engines in modern banking. And the way it works is surprisingly simple. Credit cards weren't originally designed to create massive consumer debt, at least not publicly. The original pitch was convenience. Instead of carrying cash, you could swipe a card. Instead of waiting until payday, you could purchase immediately. For consumers, it felt revolutionary. For banks, it became something even more powerful. A way to monetize future income? Every swipe represented spending today using money that had not yet been earned tomorrow. At first, this seemed harmless. Most people believed they would simply pay the balance later, and many did. But banks quickly discovered something important about human behavior. People spend differently when using borrowed money. Numerous consumer behavior studies have found that consumers often spend more freely when using credit compared to cash. The emotional pain of spending becomes less visible. And once spending increases, balances begin growing. That's where the business model starts. Not at the moment of purchase, but at the moment the balance remains unpaid. Because that's when interest enters the picture. And interest is where the real money is made.
Do you ever feel overwhelmed staying ahead of your credit card balances? Well, if so, you are not alone. Take a look at this. Americans are holding nearly $1.2 trillion in credit card debt right now. So how can people most effectively manage that debt? Well, personal finance journalist Stephanie O'Connell Rodriguez joins us here in Studio 57 with some ideas. Good morning, Stephanie. Thanks for coming in. This is something so many people struggle with. Why is credit card debt so high for so many people?
Well, it's no secret that prices have been going up and up and up. Even with inflation cooling, inflation is still happening. So life is just more expensive. And that includes those big ticket items too, things like healthcare, childcare, housing, and that leaves less left over for managing your day-to-day expenses, your groceries, the unexpected car repair. And that can really take our finances off course, and we rely on credit to fill in those gaps when the costs get too high and we don't have a plan in action to really manage them.
Most credit card statements contain a small number that appears harmless. Minimum payment, a small amount due. Maybe $50. Maybe $100, maybe less. Psychologically, it feels reassuring. The balance looks manageable. The customer feels in control. But that small number hides one of the most powerful profit mechanisms in consumer finance. When consumers only pay the minimum, most of the debt remains. Interest continues accumulating, month after month, year after year. The debt survives. And so does the revenue stream. This is why banks spend enormous resources encouraging card usage while making repayment feel flexible. Because flexibility keeps balances alive, and balances generate interest. The ideal scenario for many lenders isn't immediate repayment. It's long-term repayment, slow repayment, predictable repayment. A customer who continues making payments while carrying debt can generate far more revenue than someone who pays everything off immediately. And that's where the incentives become interesting, because banks don't necessarily want customers who never pay. They want customers who keep paying, just not too quickly.
And there are some dangers there, though, as well. I mean, I wish there were more credit literacy classes in schools here, because some people think that they need to have a balance to increase their credit score. What are some of the other misconceptions about holding a balance and having that?
Yeah, you mentioned one of the biggest myths about credit. You want to pay off your balance in full if you're able to each and every month. The other myth is that making the minimum payments is the best course of action. So the minimum is what you need to pay to avoid any late fees. But if you don't make more than that minimum payment, then you're going to accrue the interest, the high interest that credit cards have.
Which can often be more than the original balance for some folks.
Absolutely. If you're only making those minimum payments, you know, that $20 purchase you charge to your credit card at 24% interest, you know, that's going to accrue again and again, because they're only going to say, oh, you only need to pay $5 a month on this. But well, that $15 in the meantime is accruing 25% interest, and all of a sudden, this $20 purchase is, who knows, $60, depending on how long you take to pay it off. So the longer you take to pay off your balance, the more it costs you over the long term. That's how the interest works, which is why we really want to prioritize paying down the full balance. And also, if we're managing a lot of different credit card balances, paying down those credit cards with the highest interest rate first. Those are the debts that are costing you the most money each month.
This is where many people misunderstand the business. Banks don't want widespread defaults. Defaults are expensive. Collections are expensive. Bankruptcies are expensive. Charge-offs are expensive. The ideal customer isn't someone drowning in debt, it's someone floating in debt. A customer who remains financially stable enough to continue making payments month after month, year after year. Think of it this way. A customer who owes $5,000 and consistently pays interest may generate revenue for years. A customer who defaults generates losses. From a business perspective, the most profitable customer sits somewhere in the middle, not debt-free, not bankrupt, simply carrying debt indefinitely. And once you understand that dynamic, many credit card features begin making more sense. Reward programs, balance transfers, credit line increases, special promotions. Many of these features encourage continued usage while maintaining customer loyalty, because every additional balance creates another potential stream of future interest income. The real secret isn't mathematical, it's psychological. Humans naturally focus on monthly payments, not total debt. That's why financing works so well. A large balance feels intimidating. A small monthly payment feels manageable. Credit card companies understand this perfectly. Consumers often ask, can I afford the payment? Instead of, can I afford the debt? That subtle difference changes everything. Because debt that feels affordable today can quietly become expensive tomorrow, especially when interest rates rise. And over time, small balances become large balances, not through reckless spending, but through ordinary spending repeated consistently. That's what makes credit card debt so dangerous. It rarely arrives dramatically. It arrives gradually, quietly, one purchase at a time. Most people understand compound interest when investing. Fewer understand it when borrowing. When money compounds in your investment account, it works for you. When debt compounds, it works against you. The exact same mathematical principle that helps build wealth can also magnify debt. And over long periods, the difference becomes enormous. Many consumers underestimate how much interest accumulates over years. Because interest doesn't feel painful immediately, the damage happens slowly. And that's precisely why it remains so effective. The customer stays comfortable, the debt stays alive, the bank stays profitable.
Vice Chairman and Head of Investment Group at Ariel Investments. Charlie, happy Friday. Good to see you. Are you shrugging off this little maelstrom in regional banks, or is it a sign of things that you're continuing to track?
Well, you should never shrug off credit issues. Credit issues are what drive bank returns, and they always come. Most of the questions that you're asking, John, have quantifiable answers in terms of data. I mean, we are seeing banks report, and there's a clear pattern, and that is that the lower end of the consumer market is feeling some stress, and we are seeing delinquencies be higher. Car loans in the lower credit quality consumer are ticking up, and that is going to be of concern. But then there are other institutions that don't have as much exposure to that. The JP Morgans, the Bank of America's, the Wells Fargo's tend to be higher net worth, and they are not seeing any stress. And then the other thing you can measure is just people get paid for lending to lower quality companies, and unfortunately they're not getting paid right now. So what I'm worried about is that high yield spreads are at historically tight levels. I'm very nervous that we're issuing pay-in-kind zero coupon bonds, which is a sign that the company doesn't have enough cash flow to service its debt. And frankly, we have this new category of private debt that doesn't have the covenant protections that regular bank debt does. So there are things.
Break down for me why that's a worry.
Every dollar spent on interest is a dollar unavailable for something else. Savings, investing, retirement, emergency funds, homeownership. Over time, this opportunity cost becomes enormous. The problem isn't simply paying interest, it's what that interest prevents. Many households work hard to increase income while simultaneously losing financial ground through debt. And because the process happens gradually, it often goes unnoticed for years. That's why credit card debt is more than a financial issue. It's a wealth building issue. Every year spent servicing debt is a year not fully building assets. And for many households, that delay can have consequences lasting decades.
As much as $10 million. That's how much Wells Fargo is losing every month thanks to this credit card.
You can finally earn points on rent.
Bill got a very sweet deal, but Wells needed a win.
Despite high-profile failures, these types of credit card partnerships make up 62% of the portfolios of the largest issuers in the U.S., and experts say the industry will continue to grow. Here's how these complex partnerships work and what some missteps reveal about what's at stake.
A co-branded partnership is one where a bank teams up with a company. It's as broad as that.
Brands that have credit card partnerships run the gamut, from airlines to retailers.
It's any company that is looking to build up loyalty from their existing customers and to pull in new customers.
In return, customers earn rewards, anything from discounts to a free hotel night.
For free. Boom.
And the banks that team up with brands to issue the cards are looking to cash in on that loyalty.
So what's the solution? Ironically, the goal is to become less profitable. Pay balances in full whenever possible. Understand how interest works. Focus on total debt rather than monthly payments. Use credit as a tool, not as income, because credit cards themselves aren't the problem. They can provide convenience, rewards, fraud protection, financial flexibility. The problem begins when convenience transforms into dependency. And once that happens, the business model starts working exactly as designed. The truth is, banks aren't villains. They're businesses. Their responsibility is generating profit. Your responsibility is protecting your financial future. And understanding that distinction may be one of the most valuable financial lessons you'll ever learn. If you enjoyed this breakdown, subscribe to Fiscal Forge. Because the biggest financial stories aren't always happening on Wall Street. Sometimes they're happening inside your wallet, one monthly payment at a time.